Alright, so देखते हैं money market, capital market dynamics. Right, so you have financial markets here. Right, so as the name suggests, for money market is related to actual money, and capital market is related to capital. What does capital mean? It could mean stocks, it could mean bonds, or different kind of assets, basically. Right, so that is related to capital or the capital market. We have different regulatory bodies for them. What does a regulatory body mean, and who regulates the capital or money inside these markets? Who manages cash inflow and outflow, and who manages the selling and buying of stocks, and which stocks can be bought, and different things. So the money is regulated by RBI, right? We know that. So, because it issues the note, Reserve Bank of India, and controls them, right? How much to be printed, how much to be taken back. And the capital is managed by SEBI, the SEBI in India. Now there's a term called liquidity. Liquidity means how fast can you convert your asset to cash. What does an asset mean? It could mean anything, it could mean paper money, it could be a promise that you have, or it could be something like I don't know, like it could be actual money, but it was promised, or it could mean bonds, government bonds, or corporate bonds, different things. Like any asset, we call these different things as asset as one word, right? So liquidity, which means the ability to convert your asset to actual cash, is higher in money market than compared to capital market, right? Why? Because in money market you have actual money, inflowing, going around, loans and stuff. In the capital you have assets like bonds and stocks, and it could take some time to actually exercise them, to actually get into your account, maybe 1 to 2 days, and maybe more, depending on that. You have maturities, like bonds have maturities, and maturities mean like you can only exercise them after 10 years or so, right? So that. Now let's come to the differences. We have money market and we have capital market. So money market is short term, right? And capital market is for a longer period. What does short term mean here is that maybe for between a day to maybe a year, and for capital market is greater than a year, right? Now another thing is, what does money market actually does is, it helps companies and institutions with the working capital. What does working capital mean? Just day-to-day activity, raw materials they need to buy, and different things. They need to manage costs, so those day-to-day costs need to be covered, and then the companies and institutions use uh, different form of money market instruments to actually uh, manage their day-to-day costs. They could be T-bills and other things which we'll discuss. For the capital market, what actually it does is, it helps companies to raise money for long-term investments, right? So you want to expand your overall company or institution, you want to make it grow, you want to make it scale, so you raise money for long-term investments. Maybe you have a company which does work in some factories, so maybe you want to build more factories, or maybe you're working in Blinkit, you want to expand your dark stores to different cities, or warehouses to different cities. Or in general, you want to just expand your business. It doesn't have to be actual physical business. It could be a software business. You want to have more features, or overall growing of your business. You want to have more revenue coming in, so you will do things to expand your business. So for that, you are actually trying to raise money for investments for growing your company. You'll understand what does this actually mean. This could be a bit confusing in the beginning, but we'll come back to it later. So this examples for this money market, we have T-bills, right? T-bills is nothing but just a discounted actual, this full form is treasury bill. So these are issued by the government and they're just nothing but just discounted money. So maybe you have 100 rupee note and the government says that you can buy this at 98 rupees. So you get two rupees profit, right? 2 rupees profit. You realize that later. There is another thing called commercial paper. So this is like a promise to pay back the money. So you take money and then you promise to give it back. So this is generally issued by large corporate companies, and generally the sum is greater than 5 crores, and they are not generally available to normal public, like me and you, but like other companies or banks or other people who are actual bigger investors. So they're trying to raise short-term loans to manage their costs. There's another called certificate of deposit. So this is like an FD, but this is tradable and negotiable. So if in FD you cannot sell your FD to somebody else, but in certificate of deposit you can actually negotiate and trade your CD, your deposit, and get cash in exchange for that. Get cash in exchange of CD. Right now let's come back to the capital market. And in capital market, the differentiation actually works like this. There's a breakdown that needs to be done here, and that breakdown goes something like this. So you have capital market. This capital market is broken down into two different categories. What is this? Is equity and debt. So we have equity and we have debt. In equity, we have further classifications of primary market. Primary market is, as you can see, that's the first time when you can buy an equity. This is the secondary market, where you can exchange your bought shares or equities with somebody else. So this is what we're going to study, right? This is the overall breakdown. Capital market has to equity and debt. Equity has primary market and secondary market. This will be easier to understand once we go in details, right? So we've talked about what actually capital market is trying to help us in. Now let's try to understand these two parts, equity and debt. Like equity is just another form from stocks and fund, collection of stocks, like stocks or shares of a company. In debt, we have bonds, government bonds, for example, or corporate bonds. They are like a bit safer instrument, we can say. Now let's come to equity market, right? So there is another question that you want to buy a stock of a company. So when can you buy these stocks? When can you buy these stocks? So this particular question answers your this segregation between primary and secondary market. So one thing is, what is the first time when you can buy a stock? Like the company was not public before, so it's the first time they're going public, right? And they want to give shares to people. So what do they do to give shares to the public? They start an initial public offering, IPO, which we call it, right? From this IPO, the company directly gives money to retail investors or bigger investors or any investor, right? Whoever wants to buy the stock. The next time when all the people and all the initial public offering is over, the people still want to buy shares for that particular company, and there are some people who are willing to sell those, right? You have stocks for this company, and I have cash. I have cash for this company, right? Uh, so you give me the stock, I'll give you this money, and this is the exchange. Where does this exchange happen? This can happen at NSE, this can happen at BSE. What is NSE? This is the National Stock Exchange, and this is the Bombay Stock Exchange. The Bombay Stock Exchange was actually the first, and then came the NSE, which maybe computerized and digitized all of this thing, right? So again, coming back, there are two forms, two options: IPO, or you can buy from someone else. We divide these as primary market or secondary market. Now there's a concept of price here, right? At what price can you buy those shares? So in primary market, when a company is just going public, so you have a large corporate bank or corporate company, and they're trying to sell this. They're trying to, in an IPO, they're trying to sell their stocks, sell shares of the company, right? There's a particular price involved here. What price is that? How would you decide this exact amount? So there are different ways. A company can actually keep it at a fixed price that we're going to do an IPO at this particular price, or they could be, for some people, of some investors, there could be an option for a bidding. You bid a particular amount, you bid X dollars or X rupees, you bid X rupees, and somebody else bids X plus 1, or somebody else say Y, and different stuff. So there are different biddings, and based on the biddings, people get shots, those stocks. Now when you're trying to buy from somebody else in the secondary market, we have the regulatory body of SEBI. This is the regulatory body, not the exchange, right? Not where you buy, but it actually regulates the stocks and what can be bought and how it can be bought and what amount and different things. The actual buying and selling happens at NSE and BSE. These are the two different options you have. Now in these exchanges, the price is determined by the amount of people who want to buy and the amount of people who want to sell, right? And there are other different possibilities, the price. So maybe I'll just list some of them down, maybe one or two. So there is the number of sellers, there is the number of buyers, there is another problem of the market sentiments. Sentiments, basically the sentiments could be sentiments could be it could be trust, or it could be general market condition, or it could be maybe there is a war going on, so so particular like the defense stocks would go up and different. So there's price regulation, what different factors there are. You can just say various factors involved in here, right? Now we saw that IPOs that could be at fixed price, or it could be at a bidding, like an auction when you're trying to buy somebody else. It could have the price set based on different factors. Those factors could be number of buyers and sellers. So if you have a lot of buyers, right, you have a lot of buyers and they all have their money, they're waiting to sell those stocks, so the price of the stock should go up, right? Because the number of people who want to buy, the demand is actually low, and the demand is actually high, and the supply is actually low. There's a demand supply thing, and there are other factors which we talked about, right? Now coming to debt is like government, like the examples in government bonds or government securities. The government securities are one of the best because the government would not, if you have faith in your government, and your overall country is stable, almost there is almost zero chance that a government will not give you back your money, or default, become a defaulter. So these are one of the best, or you can say the safest options for asset you can have. There are another called state issued securities. So each state is issuing some securities, and they'll promise to pay you back based on those. So securities are nothing like this. You can for now assume that these are just bonds. I'll explain what bonds are. So basically bonds are nothing. So bonds are nothing, but you have maybe say a paper, right? On a paper, you say that you're giving the people this particular paper at $100, right? And after maybe say after maturity is the time after which you can exercise this bond, or actually convert it to real cash. Before that you cannot. So maturity is say 10 years, right? And they give you a 5% increase per year, right? So after 10 years they'll give you 5% of each, and based on that, the computed value, you can actually deposit this bond paper, this document, back to the government, and the government will give you actual cash in exchange, right? So why are these bonds issued, you would ask. So these are maybe you could be saying that these are T or N year loans, which the government is trying to raise, for some activity there, or some thing they want to do. So they generally issue these bonds to the public, and the public, they borrow public money. They're also issued by corporate companies, but they are not as safe because they are corporate companies. They are regulated, but as you can see, as I said, it's one of the safest. The government securities are one of the safest here, right? And again, these are regulated by the RBI. Now coming back, the first thing, we said that this helps companies raise money for long-term investments, and not only companies, you can just say institutions, right? Because the government is also involved in this. So you can say institutions, or just say institutions slash companies slash institutions, to raise money for long-term investment, right? So the company would could issue their IPO to sell their shares to get money in exchange, right? The company will sell their stocks, and so the company will sell their stocks here, right? And they'll get money in return, the actual dollars from the people of whoever is buying this particular stock, the investors. They could be forming a bond to get some cash. So these are the things, different ways they are trying to actually get money for their investments and expand their business, right? So that's it. If you have any doubts, and let me know.